then I have to click the record on this computer. So, and we are ready to go. David, good to see you. How are you doing?
Hey, very good. Thank you for having me.
It's very good to have you on the show. Especially in these days, I think your topic is one of the hottest topics ever. And let me give you a little bit of background to my understanding to your hot topic, private banking. I remember when I started in the first life science company, we got a VC financing round of 40 million closed. It was back in 2006. And with more than 1 million euros on the bank account came the invitation to the holy halls of private banking in the good old Austrian banks. And I exaggerate a little bit to get the story going. And to me, I mean, it was 2006, I was a little bit above 30. And we drove with a cab to the headquarters of the bank. Were allowed to board the elevator to the last floor, to the private banking floor, and were seated in a really lovely room and waited for half an hour. And after 30 minutes, we were allowed to enter the main hall of private banking, which was a huge office with a huge table. And there we got served in banking everything we wanted. And this basically formed my picture about private banking. When you are rich, when you have enough money on the bank account, you get special service at banks. And I believe it was just the best practice in banking for centuries since banking was invented, that the more capital people have, the more service they get from banks, which makes absolutely sense from the banking point of view and from efficiency point of view. And when your colleagues reached out to me and said, we want to innovate private banking, I just was thinking, how do we want to innovate that? What's the innovation with that? And this leads me to my first question to you. What's your background in private banking and why do you believe you can innovate it?
Yeah, thank you. The most important question already. I think we can stop afterwards. So first of all,
No.
well done that you managed to reach wealth at 30. I think this is the problem. What happens to most pan-Europeans or most people around the world, that they cannot build up wealth anymore. So this is the first big challenge. And the second one you mentioned, now is the perfect time to talk about this. I think it's always the perfect time to talk about this because everybody should take care of their financial future. So a little bit of background about myself. I'm from Austria, from the south of Austria, from Styria. And I came to the big city of Vienna to study here economics. Then I went to work for RBI. RBI is a holding bank owning 17 banks in Eastern Europe. And what I was working there as was as a fund selector, it's called. So fund managers would fly in and out and show us their investment approaches, how they want to beat the benchmark, what they're doing right, what their investment teams are doing, how their performance is. And we were kind of analyzing and evaluating those asset managers and then put them on a short list, which were allowed to be sold within the banking network. And what the really cool thing about it was that I saw hundreds of different asset managers, what their value proposition is, what their added value can be, and how they approach the market. And I can tell you there's thousands of ways leading to Rome to really beat different benchmarks. But what was most appealing to me was a kind of quantitative way, so taking out the emotions of investing decisions, because I firmly believe this is the biggest mistake which is happening in the market. People act emotionally, and especially, maybe we'll get to that later, especially in this current environment, if there's a lot of news in the newspapers and all around the TV about the world burning, it's very tough to take rational decisions. And the second thing which really appealed to me was value investing. So not just buying attractive companies, but also buying them at an attractive price. And I stumbled upon during this time one manager which I went to, which is called Lingo and Partner. It is an institutional asset manager managing money for sovereign wealth funds, for university endowments in the US, for pension funds in the UK, and so on. So our minimum ticket was 50 million euros. So it's really the big institutions. There I was portfolio manager, managing around 4 billion in long-only equity mandates. And what I learned there is definitely that smart research built into a process which kind of guides you throughout good and bad times, and where all your research is built upon the past research, which makes an approach not only valid but also repeatable, really makes sense. And this also, I was there for a few years, and this also led me to doing what I'm doing now, because I saw what we're building there for really wealthy clients. We could also do for everyone, obviously in a little bit slimmed down version, but to take the time to really think, how can we offer what's so much needed for everyone else, but the wealthy few should be available to everyone. And this is why I did an MBA in Madrid, in order to kind of validate this with people out of different disciplines, and not only investment specialists who all agree with each other.
I mean, when you say private banking for everyone, the best thing I remember from the private banking meetings was the dinners and the lunch events. Does that mean lunch and dinner for everybody?
No, not at all.
What is your definition of private banking? Let's start with that one.
Yeah, so last time with the client, I said we have no concerts, no operas, no polo tournaments, no bullshit.
And I think good point.
That's exactly what we're doing. I think the most important thing is to take apart what is the added value of a private bank. And I think the added value of a private bank is definitely that the private bank takes the time, or at least the approach, to look what are the client's needs. And this is probably what they also ask you while you were sitting in the nice couches and getting the very good barista coffee. They were asking you what you have and where do you want to go to. And I think this is the most important part, because only if you know the client's goals, then you can invest accordingly. And I think this is the major good thing about private banks. First of all, they ask you what you really need in life. And second, they build something which is not off the shelf, but which is made for you. I think all the surrounding is mainly built for trust generating things, but it costs a lot. So therefore, a private bank can only take someone like you once you have $1 million, but they cannot do it beforehand because they do a lot of things manually. There are a lot of inherent conflicts of interest because they obviously earn most of the money by selling their own products. So they don't have full alignment with the client. So what we wanted to do is take the good parts out of private banking. So the approach, starting on a white piece of paper, what a client really wants, and then building a smart, sophisticated approach, which is suited to the life of the single client, and take out all the as you know, bullshit.
No, I completely agree. I mean, the best parts of this meeting were the educated bankers that really were interested to understanding where the money should go, what the long-term goals are, and really seemed to have the know-how and the expertise to support decisions. The downside, I completely agree to what you say. I mean, when you're invited by Erste Bank, of course they need to sell their products and they can't offer other products, especially 10, 20 years ago. Most of the financing solutions were introduced to the market by the banks. When I went to Raiffeisen Bank, of course, I mean, I got the offers from Raiffeisen Bank and also Volksbank, it's just, I think, decades ago. This, I think, was very problematic because very often solutions that were the best ones, like Berkshire Hathaway, for example, were not really products of banks. How do you fix that? How does your team have the ability to act completely independent?
So in the end, as I said, we're doing the whole process from end to end so efficient that we can also offer this to someone only putting in 150 euros a month, which is still a lot for people who don't earn that much. And I know that a lot of Austrians have to work from payroll to payroll, and they cannot afford this. But at least it's already lowered the limit. And since we offer this investment approach at such a low barrier of entry, we have to do it so efficient. And this efficiency we give to the big clients. And therefore, we can offer this and take only the management fee for really managing the portfolios, and not for all the nice houses and couches and dinners and polo tournaments. So we really try to make everything without manual work, which doesn't have an added value. And for client meetings or things where people have added value, we stay human.
So your solution is available for everybody who has the capability of putting 150 euros per month aside. Did I understand that right?
Correct.
Wow, that's amazing. So you offer private banking for basically students. Is this the right understanding?
Yeah, and in the end, for students, it would be even the best because they still have such a long-term horizon, so that they can really take advantage of the only real big advantage you can have in the market, and this is think long-term. Because in the short term, investing simply doesn't make sense. In the medium term, it's okay-ish. The risk reward is okay-ish, but in the long term, it's just unbeatable, and it's a no-brainer to do.
Why should, I mean, well, when it was the 90s when I was a student, so it was a long time ago. And I started in 1995, and the thing was, whenever I wanted to invest something, it was really difficult to buy a stock or anything else beyond a normal savings account. Why should, in your opinion, why should students care about private banking? Why should they do that? I mean, when they are in their 20s, the world is open to them.
Yes. So I think you're completely right. And I think now a lot has changed. So people have access to many things, especially do-it-yourself propositions, and they can start. Obviously, they should enjoy life, as we all did, and
with coffee,
and also use their money. Nonetheless, once you open their eyes and their curiosity to compound interest and how money can work for itself, I think everybody finds out that it really makes sense to at least put something aside. And you probably, it seems like you have done a tremendous career. If at every career step you don't increase your expenses the same way, you will also be happy, and you can put aside something. And therefore, I think if you manage to take away 150 euros a month and you start at 20, you have a huge advantage towards everybody who wakes up at 45 and thinks, oh, maybe I have to take care of my financial future. Because by then you will have learned a lot, you will have understood a lot, you will already have seen the tremendous power of compound interest, and you will have a big advantage because you will already have something at the side.
I'm curious to hear your opinion. I had Brian Faroldi on my podcast a couple of weeks ago. He wrote the book, Why Does the Stock Market Go Up? And he is working, he's a writer at Motley Fool, and it's really a great book. It's the principles, it's the basic of investing. And I'm interested in your definition of compound interest. What is that? This is when somebody wants to start investing, they get this term compound interest on the table. What is it?
So in the end, compound interest just means that the part you earn already starts earning again. So the child you get gets other child. So it's kind of like a family or a tree also. Like each branch gets new branches. And in the end, that's exactly what happens. If you make 10% a year and you start with 100, then you get 110, and then you get 10% over the 110. And this kind of becomes an self-sufficient system. And this is also why it's so important to reinvest dividends, to reinvest everything you have. Because as soon as you make a yield and you keep letting it work, it can compound to a lot.
And you think 150 a month is enough?
Yeah, definitely. So there's this easy thought game. If you start at your birth, so obviously your parents or your godfather or godmother or someone else has to do it. But if you start at the age of 0, so at your birth, and you put in 110 euros a month for 65 years, so until your retirement, with not taking tax into consideration, you would end up with 1 million. So this is the real power.
After how many years?
65. So when you retire.
65. Okay. Wow. 110. You said.
This is yes, really 110 euros at 7%. You end up at 1 million. And if you calculate this, 110 times 12 times 65.
You have a calculator on the table, right?
Yeah, I've made this example often. So it's around 85,000 euros which you have paid in by then.
But if it's so easy, why is not everybody already doing it?
Because it's very boring. It needs a lot of. Yeah, I mean, what we are doing is really not reinventing the wheel. We are just doing something which has been done for hundreds of years in a very smart manner. But what you need is patience. You need conviction because you need to stick to it. Most of the mistakes happen because people lose their conviction once there's a crisis. When they need money for a new car, they take it out. Like there's this usual analysis that every asset class or every fund invested, they had to look at it. What's the performance of the fund? So there's this famous funds which make like 12% per year, and they had a look what does the average investor in this fund made as a dollar-weighted performance, and it was always 3 to 4% less, just because they always buy at the wrong time. So whenever the market is up, and sell at the wrong time when the market is down. And this is exactly what is happening all the time. There is kind of, we as humans, we're built in the wrong way. There's in my view, a paradoxon of risk. So when the perceived risk is high, as it is now, the absolute risk might be much, much lower because prices are already low. When the perceived risk is low, as it was second half of 2021, when there was this huge funding rounds, this huge or high prices paid for stocks as they would grow forever. The perceived risk was very low, but the absolute risk for a real investor would be very high because you pay a high price for future expectations which have to be met in the future. And I think our human mind is not made for this kind of contrarian thinking and this long-term approach because it is simply not as sexy and fun as trading with something where something is happening every day. And you really need to have a conviction to also go through the droughts, which will come for sure.
You're absolutely right. When I think back to November 2021, I think the only person that I'm aware of who said sell in November 2021 was Chamath Palihapitiya. He's one of the podcasters at the All In podcast. He was at Facebook and ran several funds in the United States. And in one of the All In podcasts, I think it was 55, he said the two smartest people on this planet, Elon Musk and Jeff Bezos, are selling assets. This should be a warning. And whenever I opened YouTube, there was a plethora of videos of just saying one thing: buy, the market is great, the party will go on forever. So it was really challenging to listen to the one voice and silence all the other voices. Yes. Now when you open YouTube, I mean, the message is quite clear. Armageddon is coming. We will all be poor. And every single, let's say every second video has a title like sell, it only gets worse from here, there is no positive future. What is your team doing to avoid falling into this trap of just following the herd?
Yeah, first of all, I think one important thought is that whatever you read in a newspaper, whatever you hear, whatever you know, probably all the others know as well. So the one who is selling you the stock has the same information than you, unless you have really insider information. So usually all the data is available, everybody's reading the same papers, everybody's watching the same TV channels. So therefore, you need something else. So in the end, smart investors, for example, which I can advise everyone to do, is read the memos of Howard Marks, which was the founder of Oak Tree Capital. He's a very interesting guy, but he calls it second level thinking. So he says you have to take into consideration what everyone else is thinking and really then base your decision on what everybody else is knowing. What are you knowing which they don't know? Or what do you think is already in the prices? And what does the market not see? So where do you have an edge? Well, this simple thing, the macro outlook is bad, doesn't mean that the return will be bad. If it's already embedded in the prices, then it can also be a good return because the future is less bad than the market expected. And this can already help you to earn a good return. What we do in order to do that, and as I told you, I worked at a quantitative fund, so we also do everything quantitatively. So what we look at market valuations. We look at different regions within the equity market. We look how expensive are they compared to their history. How expensive are they compared to each other, and how expensive are the difference between the valuation of the different regions compared to the history. So what you get out of that, in the end, you see where is the market currently not looking at. And what we have to take into consideration, every market, every life, everything in the world is kind of partially in a cyclical way. It might be emotionally, it might be real. So earnings are going up and down, emotions are going over the earnings up and down. So what you can do is you can have a look, what are the most attractive markets by saying, where do I get most cash flows? And in the long run, it always comes back to the hard reality of cash flows for the least money. And this is how you find the most attractive places to invest for the future. And the same thing we do, we compare different asset classes towards each other and different styles within the asset classes. And then we build portfolios according to the time horizon of the clients. So what we do, we really use the computer to compute unimaginable many numbers just to give us every month on a printed sheet something which is telling you this would be the right thing and the rational thing to do. And then what we have to do as humans, we have to improve the process. So we have to find what are the blind spots of a computer, what does a computer not see, what does a computer not understand, in order to kind of build it into the portfolios of the clients and to improve the process for the next month.
Reminds me of the words of Ray Dalio. So it's his all-weather approach.
I wish this is probably the biggest compliment I've gotten so far.
No, it's great work you're doing. When we first got in touch, so let's wait if you give me another compliment right now when I finish this sentence. I thought, oh my God, the next app. So Bitcoin until 2017, I think in 2017, Bitcoin took off and a lot of people lost money. Then during the pandemic, we had Robinhood. I mean, it was fun and entertaining. So when some gambled against big companies, especially short sellers, I think everybody on TikTok had fun with GameStop. There were memes, there were songs written, and it was interesting to see how a crowd of retail investors can take down big short sellers. But at the end of the day, I believe a lot of money lost cash with Robinhood. How is your app different? How do you differ from apps like Robinhood? Is it pretty much the same, or is there something that you are doing differently?
I mean, it's basically the antithesis to it. We're doing the exact opposite. We're trying to not. So what's really cool about Robinhood and all those apps is that it got a lot of young people and people who have never done it before start investing. So to kind of trigger their curiosity to start investing and to kind of get a feeling. And the most important thing for each and every person in the world is also to understand itself and the boundaries. So to understand, do I have sleepless nights when I drop, or when my portfolio drops 20%, or can I handle it? What do I know? What do I understand? What turns out not to be like it's supposed to be? How little do I know about the company? How do I take decisions? Whether the right decisions, whether the right decisions for the right reasons. So there's many things which people can learn. What's really dangerous in my view is this gamification of something very serious like investing for the future. You must think this is one of the most precious things. People go to work every day to end up with as little as maybe 150 euros a month to be invested, and then they take only one kind of quote from Reddit to make a decision how to invest this money. And this is like this is really dangerous. And keeping in mind always, you do it for free, but they are incentivized to let you trade as often as possible. So this already means you have no alignment whatsoever with those kind of trading platforms. And in the long run, if you want to build up wealth, as I said, you need time and you need patience. And this gamification triggers something in your head where it will be, unfortunately, very tough to switch to something boring and long-term once you're caught up by enjoying this thrill that you could become rich in a day or poor in a day, or that it drops and increases by a lot of percent each and every day. So I think generally they have done a tremendous job in giving access, also for small money, also improving the efficiency. So therefore trading costs have come down a lot. People are starting to engage with it, but I think it's the wrong mindset to build up wealth in the long run, because only very few of them have really educated decisions they're taking. And most of all, they're not thinking of the long term, which is the only thing. The market is irrational and will stay irrational. The more people are doing like this, the more irrational it will become. And the more you need a long-term horizon to position yourselves and to stick to your guards, have a plan and really execute according to your plan to make most out of your wealth.
Yeah, I completely agree to what you say. I think the upside of the Robinhood story is that a lot of young people got interested in investing at an early age. There was also this fire movement in the United States in the last 2 or 3 years, where people tried to reach 1 million very quickly with living frugally and investing everything they made. And very often they lived in their parents' houses so for a longer time, so that they have money to invest.
Every Italian does that. Every Italian does that.
Really? Is it?
Stay in hotel mama until you're 35, isn't it?
It has some upsides. I moved out when I was 20, so I can't remember. I don't know how to do that, to live at the parents' house. But the thing, what is definitely true is that it's much cheaper and people have more to invest. The downside, I completely agree to what you say, to Robinhood, is this trading attitude. I made an experiment in my life. It was back in 2015 and 16, and wanted to figure out if I can do the most simple thing, buy low and sell high. It never worked. So it really never worked. The investing style that I'm most comfortable with is a game by itself. It's investing in deep tech and in tech companies, and the volatility is just insane in these areas, and the risk is also very high. But trading never worked for me. When we talk about investment styles, and you said you have a quantitative approach, do you trade, or is it also that you buy more assets to hold them?
Yes. So usually we stick to the very long run. Obviously, we challenge our decisions which we have made, but we're no traders, no, not whatsoever. So usually we would hold ETFs, ETCs, or assets we have for a long time. Definitely, this also makes sense if you position yourself, especially in a contrarian way. It will take a long time. It will take a long time until the market reevaluates what it has done, and cycles can take. So the cyclical adjusted PE, the Schiller PE, which is done by Professor Schiller, which is supposed to show the price you pay compared to one cycle, is 10 years. So then you can imagine a cycle can take 10 years, or on average 10 years. Obviously, it can be 1 year or half a year or 15 years, but on average, and this already shows how long it can take for the market to reevaluate. And you can also see that, for example, now if you look at market valuations, you see that in 2007, an investor investing in emerging markets, which is China, Korea, Taiwan, South Africa, Brazil, in those companies was willing to pay the same PE ratio, so the same multiple on earnings for an emerging market company than for a US company. And in the US, you have to know this is a different setup, so different companies, different industries, mostly earning higher margins. And emerging markets always come with currency risks, with political risks. So they must have assumed that there's much more growth coming from emerging markets than from US. Otherwise, it's not justifiable. Now, 15 years down the road, you already pay double of the price for €1 earnings in the US than you pay in emerging markets. I think both are kind of far from their long-term average. So emerging markets is now at their 13th quartile, so percentile, sorry. So it has only been more expensive in 86% of cases in history, and US is at the 10th percentile, meaning in 90% of the historic time frames, it has been cheaper than it is now. So everyone went into one direction, and nobody knows how long it will take to kind of get back into a normal range, but it will come back. At some point, already the US already came down quite a bit, but at some point it comes down back to the hard realities of cash flows. How much do you get for buying something for €1? As it is with buying the bakery next door. If you pay €100,000, you get €10,000 of earnings every year. It's a fine investment. You will have paid back in 10 years. If you pay $1 million, it will take 100 years to buy back. And this might not be a good investment forever unless the earnings grow as much as it is a reasonable investment again. If you can buy it for €50,000, you will find hundreds of people who will buy your bakery because they will have paid it back in 5 years. So it's very easy when you think of it in a normal sense, but people starting once the wrapper of a stock or something or capital market is on top of it, they lose the connection that this is really a cash flows you're buying there.
I was just smiling because you said the market has come down a little. I think every investor in tech companies experienced a drawdown of 70, 80%, 90% sometimes. I think Peloton, for example, when I looked at it, I think it's down 90%, Coinbase 60%. Cathie Wood's funds were up 150% in 2020, 2021. And now I think also she lost 80, 90% of her investment. Interestingly, Warren Buffett's bets like Apple didn't correct much. I'm curious for your opinion, for your crystal ball. Is there still room southwards so that the markets can go deeper, or did we already see the worst?
If I would know, I wouldn't have to worry. There's easy instruments in the market. If I would have a hinge of what's going to happen, then I would be rich by now. What I think is definitely important about the stocks you were mentioning, or the fund and the ARC Innovation Fund. Those ones really did what I mentioned before with the perceived safety, or extrapolating past returns into the future and leading to kind of herding. It led to catch the people off guard by paying a very high price for very high expectations in the future. And even though they all still earn good money, many of those companies, and Netflix is a good example, but still their expectations of the average investor was much, much higher. So they had much more risk on the downside by not meeting their expectations than just delivering normal returns. So I think it came down, the US market, or especially the tech stocks, came definitely down to a more reasonable price than they were priced last year. If it's the end, I don't know. I have no idea. What is a good investor? What do you usually do? You think of what could be the scenarios in the future which can happen, and what's the probability of this happening. So usually in a normal environment like now, you would say there's different possibilities. One is soft landing, meaning the central banks manage to kind of get out of the inflation in a reasonable way, and we get back on track. The other one is a stagflation, which you already mentioned briefly, meaning there is high inflation but low growth or no growth, which is a dangerous environment. Another one is a recession. This might be short or this might be long. So what you as an investor would do, you would think, what's the probability of those happening? Or do you want to hedge against those? You know, risk is always that there's more things can happen than will happen. And this is exactly how everybody has to build their portfolio. Nobody knows what's happening. And I'm not an economist, but also I guess economists also don't know what's happening. It's too complicated and too complex, the system by now. But you should build up your portfolio that in all of those ranges, you should have a portfolio which in the long run can produce attractive returns.
Yeah, there are definitely interesting approaches on the market. So we mentioned three already in this call, in this talk. Kathy Wood with her tech investing approach. I think it's closest to the VC approach I read today. I got an invitation that she also now has set up a venture fund that she's introducing today, I think 4 p.m. East Coast time. Then we have Ray Dalio with his all-weather approach, which I think is quite interesting in those times, and Warren Buffett with...
Yeah, but Ray Dalio just left Bridgewaters. He retired.
Oh, really?
Yes.
Really? Definitely.
But I think he has very good other people there as well.
Yeah,
so
I absolutely believe that. And the interesting thing on the market for me is that the pendulum always swings back. This is something that it's quite amazing. When I think to 2015, so tech was just taking off. I think also Cathie Wood started in 2014, and the electricity sector was really down. So nobody invested in electricity companies. And when you look on the market right now, it's just reverted. It's just like an inherent law. Would you agree with that? That these market swings always happen, but nobody knows how quick they are or how long they are. Is it something that you could agree on?
Yes, definitely. So I think it's called reversion to the mean in the finance world. It means that everything comes in cycles, and this has obviously many rational things. First of all, when you think of cycles within earnings, margins, revenues, this happens if you think for a company entering a market or opening a market or reinventing a market, earning high returns on equity or high margins. This will attract competition as long as it drives down the prices to the cost of capital. So this will always happen. Once you enter a market where you can earn unlimited money, a lot of competition will come in there and drive down your prices. Same thing happens on the lower part. So those companies not earning enough to finance their businesses, they have to reinvent themselves in order to be capable of getting new money, of paying their employees, and so on. Therefore, everything from the upper part and the lower parts, they will always converge towards the cost of capital in the long run. So this will always happen. On the other hand, companies which have more than 20% annual growth rate, they will not be able to hold this for eternity. But the more mature they get, the more their earnings growth will converge towards a normal annual growth rate of, let's say, 3 or 5% or something like this. And this is what's happening in companies. So earnings in the long run, there's a positive trajectory because we as a society, we grow, companies become more efficient, companies reinvest their earnings. So therefore the trajectory is a positive one. But above those cycles which happen in the earnings, there's emotional cycles. Mm-hmm. So if you have delivered tremendous returns for the last 2 years and increased your earnings by 50% a year, someone is willing to pay a high price for €1 earnings. As soon as your earnings fall, people are willing to pay a low price for this earnings because they extrapolate this too far into the future. And therefore, those little cycles in earnings become big cycles because there's emotional swings on top of that. And I think this will always happen as long as humans are engaged in those topics. And even if it was only computers, the difference would always be what kind of time frame do people have. So do I look on 20 years or am I just looking on the next 2 months?
Yeah, I think investing is always for the long term. What goes into an investment account is bound to stay there and not taken out. When I think about the future of private banking, so we were talking about now, the past, and what's going on in present. What's your vision of private banking?
So I think the human interaction needs to be at some point because it is a trust business and it's important to help someone to structure their life. So I think the only human thing which should be there is the financial planning. Let's call it financial planning. Mm-hmm. And everything else needs to be done without emotions, without conflicts of interest, and systematically and technically enhanced, and therefore at cheap prices, because otherwise the client has the risk of the market volatility, but paying a high price for that really doesn't make sense because this kind of shrinks the possible returns by a lot. So therefore, I think private banking in the future would be that at any point in time you can have, like we have a video conference, and it doesn't have to be from Monday to Friday, 9 to 4 p.m., but it can be anytime. It should be really stick down to the most important things, and then take a very smart long-term approach suiting the goals of the clients and meet once a year and reevaluate whether the financial planning has to be redone. Because this helps a lot by defining goals and time frames to also make it much more reasonable for an asset manager to take the necessary risks to do so. So as an easy example, we also have very big clients. For example, if I invest money for a trust and they say their people or the people behind the trust, they need 100,000 euros each year out of their assets in order to maintain their life. So I could say, first goal is 100,000 in 1 year. So I take very little risk in this portfolio. 100,000 euros in 2 years, I take a little more risk. 1,000 euros in 3 years, 100,000 in 3 years, I take a little more risk. And everything above 5 years, I take a long-term approach. So when I meet them, it's very much a different mindset than it is with everyone else, because I can explain then your portfolio, most of your assets you have, a few million, they are down 10%. But don't worry, because the 100,000 euros for next year is in this dangerous market environment only down 2%. The 100,000 for next year, they're only down 3%, which they can already much better accept the volatility for the long-term approach once their short-term money need is met. And it makes it much easier for me, because otherwise every private bank takes a too risk-averse approach for the whole assets you have, because the private banker simply doesn't want to tell you, sorry, but Christian, but your whole portfolio is down 10%. I know we screwed up, but how about you come to the next tennis tournament?
I would be happy with 10% right now. So after the last 9 months, I was a hero until November 2021. Now let's just switch the topic. I mean, in these days, 10% drawdown is great. I think I'm at 40 or 50% or something. It's just this tech market. I mean, it's really complex what you're doing. So you consult, or what your team does, you consult wealthy clients on one hand, or big funds. And on the other hand, you also structure solutions for retail investors who are in the process of building their first million. How do you get it together in your company? Isn't that very complicated to have these different goals in the same entity?
Yes, definitely. It's like if it was easy, everybody would do it.
Yeah, absolutely.
It is difficult, but I think it's a very coherent system. So we make the investment approach for the wealthy one, which we offer to the normal client. We make the process efficient for the normal client, and therefore we can give the price advantage to the larger clients. So I think it kind of as a system works. Obviously, it is difficult, especially to target those people. So wealthy clients do not want to have the same thing than normal clients, and normal clients have to be approached in a different way. And the language is different. The way of explaining something is different. The things they want to see are different. The depth of what they want to understand about the product is different. Obviously, this is a challenge. What we have in our purpose, in our company purpose, is that we want to really help clients to build up wealth in the long run. And this is meant for everyone. So this is not meant only for the lucky few, but this is meant for everyone. And this is also the reason why we're doing this. This is what keeps us going. This is what keeps us getting up in the morning. Obviously, we need wealthy clients, and we love wealthy clients because we learn so much from them. But in the end, we really want to also have an impact, and we want to make a change, and we want to help as many people to start investing and to build up wealth in the long run.
I mean, let's stay a little bit at this point of the conversation, founding your company and what motivates you. You definitely have a lot of expertise acquired. I mean, we already had it in the first 50 minutes of this conversation, that you know a lot about investing and you have access to wealthy clients. And one thought that popped up in my mind is, I mean, why don't you just stay on a consulting level when you already have a clientele that you can work with, that is interesting to work with, that brings a lot of capital to the table, that you can invest according to your expertise and produce returns? What drove you to open private banking basically to the public, to everybody? And I mean, it's putting more work on your table and more work on the table of your team. What was your motivation to go down this route?
So first of all, I'm a very politically thinking person. And in my view, the times of our parents is over where we can totally rely on the state to maintain our standard of living. So we have to take our action and have to take our own finances in our hands, take care of our own financial health, take care of our own future. And I think this is very, very important. The difference between what a wealthy person gets and a normal person gets is simply too high for no reason. And we really want to make an impact. So there was one, funny enough, the founder of Robinhood, Flantenev, he once said in a podcast, which I thought was kind of inspiring. He said, when I walk through the streets, I see a lot of houses, hospitals, banks, subways, all big things. And they were all made by people which are probably not smarter than me. So the only decision I had to take is, do I want to be a passive part of society, or do I want to change something? And I think this is kind of it. We really want to make a change. Obviously, we want to build up a sustainable, good company and earn money with it. But we also want to change something in the world, in the perception, and help as many people as possible to gain financial freedom. I think I would have a hard time finding this kind of cool, interesting, smart people and investors if I was just doing something for the money.
What drove your decision to become an entrepreneur? I mean, with your expertise, it must be easy to get a high-paid job with a team in one of the big funds that are already on the market. What motivated you to found your own company? Why did you do that?
Yeah, I mean, the people often ask at those startup conferences, so how can you motivate more people to become entrepreneurs? And I think this is completely the wrong question, because in the end, you should not motivate anyone to become an entrepreneur, but it's only if there's no alternative you should become an entrepreneur. You just have to feel it, because I can tell you from my own history, and probably the future will be the same, it's a tremendous roller coaster of emotions, of setbacks, of tough times, and also of euphoric, great times. But you really need to be in for the long run, and there needs to be no alternative. Otherwise, you will never handle this kind of emotional roller coaster which you have to go through. So for me, it was clear that I want to build up something which I imagined in my head and want to make a change.
That's great. That's the best motivation to start something. I love it. I mean, entrepreneurship is not like golf, so it's not like a game for one person. Like this term, what is it, solopreneur on the market? I mean, entrepreneurship is always working with a team. How did you find your first team? How did you get your idea started?
So as I said, after my experience in the fund, I did my MBA in Madrid, and really took this time to really think of how we want to set up the whole business, and what kind of things we have to think about, and also to get input from people from other expertises. So what I did at the MBA, I went there with the only idea to set up fruits. And I took all the resources which the university had, from consultants, from advisors and mentors, university professors. They gave us access to all data libraries, financial tools. And also I set up a team of 6 people out of different backgrounds. So one was from Mayer-Kinsey, one was from BCG, one was a mathematician, and one was a marketing engineer, and one was an architect. And we really took the whole year to work on this, get challenged, took part in a lot of competitions, and won all of them. And after doing that, one of my colleagues, funny enough, the architect, it's Dirk, my co-founder, he's Dutch, and Dirk and me, we just took our laptops after that, took the plane from Madrid to Vienna, and set up fruits. This is how we got, how I found my co-founder, and this is how we started. And from that on, it was
So
really...
it was a flying start.
Yes, it was a flying start. And from that on, really day and night, we're trying to find the best people as investors, as employees, as colleagues, as partners, and so on. So this is our main aim. The funny thing about an asset manager is we don't have any assets. Our only asset is human capital.
That's interesting. That's interesting. So no big buildings, no fancy offices, no big cars.
Nothing.
Nothing, just human capital. When founding a startup, I mean, there is this phase where you find a team, where you have a vision, where you have an idea, build a business plan, and then you said you came to Vienna, and Vienna is, for me, it was always the place of, you get everything funded here in Vienna, except tech stories, except complicated stories, because the return expectations, in my opinion, here in Vienna are very, very short term. So it's not something for the long term. We still have, I come from deep tech drug development, so in the last years, and we still don't have funds in that area. The interesting part when starting a company is the moment when the team realizes that it needs external capital. How was that for you? What motivated you to go on the market fundraising?
Yeah, so we knew that for us, in order to be successful, it takes a very, very long time. So we're not the sexy quick buck for an investor as some of the tech startups. So therefore, we're very different. We're in a highly regulated environment. So it already took us almost 2 years to get all the licenses from the financial market authorities and so on.
Really? 2 years?
And so we had a lot of pre-financing needed, which Dirk and me put in. And we took on our first investor after a little more than a year. We only took the money because we thought this is an incredible add-on to us on many senses. So on input, we already had a few advisors, but on input, on credibility, on kind of experience. We have a cool thing. We have a lot of young people in our company. So young meaning 30 to 40, but we also have a lot of interesting older advisors. And I think we have a good mixture of...
What is old for you?
Yeah, I cannot win with this question. I don't want to answer. No, but I think what's really important is to take those tiny worries which you have along the way and the hiccups and the market times to put them into perspective. It's very good to have sparring partners which have seen much more things, which have seen different environments, which have seen what's possible in 10 years and what's not possible in 3 months. And to kind of match this and get the right people on board, you have to think of, usually startups search for money and they can promise an exit at some point, or at least they advertise that they will make an exit, which is very big in the short run, and that they get venture capital money on board very quickly, and that they will grow to the sky in a matter of weeks or months. And for us, it was always clear investing is long term, and we see it now. Our clients, on average, have a goal which is 19 years in the future. So we also have to build up our business for the same time frame at least. So we always said we want to build up something for the long term. We wouldn't do it if we cannot imagine to do this the rest of our lives. So therefore, we also need investors who are in for the long run, and as our clients, in for the boring but hopefully growth and compound interest story, which is very, very far in the future. With at the beginning, obviously, still a lot of risk. I think hopefully the risk decreases from year to year or from day to day. But therefore, it was very tough to find the right people with the right mindset who want to change something, who want to build up something beautiful in the long run, but who are not greedy on the short run, than to kind of become part of the fruit story.
Now, these great things that you say, I think this is one thing many people like to overlook when they want to become entrepreneurs. There's always this, the end game is always interesting. Jeff Bezos, Elon Musk, so after decades, but nobody wants to see the in-between. Entrepreneurship is pretty boring because every company is just set up for one thing, doing the same thing over and over and over again for decades. And there is nothing exciting in it. So it's just basically doing like you. I mean, you're investing over and over again for the next 2 decades. And the investment principles, I think, they don't change much.
But that's for example, an interesting thing, which you already mentioned partially. There is Warren Buffett on the one side, and there's Jeff Bezos on the other side. Both have built up multi-hundred billion companies. What sets them apart is with Amazon, only Jeff Bezos and probably a few others became really, really rich. With Berkshire, there's a lot, the group is called Berkshire Millionaires. Because there's a lot of people who put down money at the very beginning, invested in Berkshire, and still are invested in Berkshire, and their stocks became worth so much. Even though there were roller coasters, there was the tech bubble, there was the global financial crisis, and so on, because they had trust in the long run. And it's exactly what we discussed before. For Jeff Bezos, it's very different. Like 2001 or 2, after the tech bubble, the Amazon stock was worth almost nothing. So most probably those investors which are in there now, like almost no one of them has invested at the very beginning. So they didn't take the long road, which they did with Berkshire, where they really did the boring long-term game. And obviously Warren Buffett did a very good job. But also if they would have just invested in the S&P 500 for the same time frame, they would also have made a lot of money.
What I find impressive with Warren Buffett is this average of 20% return per year, consistent over, I think it's the 6th decade now that he produces that return on average. Every year when I open the Berkshire report, it just says at the bottom 20% in average, and it doesn't change the figure regardless of what the market is doing. And when I think back to 2015-16, a lot of people were not really happy with Warren Buffett's approach because they said he missed the tech train. He didn't invest, I think, in Amazon. He invested very late in Apple. And Jeff Bezos did another interesting thing. This has nothing to do with investment, but the one key figure that I remember from the Amazon story is in the pandemic, from the big on one hand, the good thing is that I think everybody benefited from getting parcels from Amazon delivered to the doorstep when all shops were shut down. And I think the highest number of employees he had in Amazon globally was 1.5 million. I mean, just imagine that, creating 1.5 million jobs. Isn't that amazing?
Totally. I think with Warren Buffett, you already see how smart he is, because he can explain things in a very easy way. And this is only if you have understood something from every vantage point, you can explain something in this easy way. So from all his words he's saying, you can really see that he's seen through the problems and especially the most important things about it. And this is the only reason why you can explain something that well. And also what he did, what very few do well. So many people have one style, one sector, one whatever, which they invest in, where they're good at, but nothing works for the very long run, because also this is there's simply cycles in everything. But what Warren Buffett, for example, did, he started investing in cigar butts, so very cheap stocks where he could take one puff out of it and then got rid of it. So really deep value investing. And throughout the time he changed, which was very important, because you have to imagine, like 50 years ago, there was interest rate of above 10%. So it really made sense, his investment approach. And as the interest rates came down, he switched to companies, so good companies for a reasonable price, which have the moat, so a moat around them, which protects their competitive advantage. So he really managed to, throughout the cycle of interest rates, of market environments, to switch also his approach towards those kind of stocks which bring attractive returns in the long run. So I'm very curious what he's going to do in the next few years. I hope he stays under us for a few more years. But it's very inspiring to see and listen to him.
Me too. Every April, the Berkshire Hathaway annual shareholder meeting is a must, I think, for everybody interested in investing. And I hope Charlie Munger and he stay around for a couple of decades, which, I mean, Charlie Munger is 98 and I think Warren Buffett is 93. He did a lot of smart things. And I think this is also the difference between retail investment and professional investing. It's easy to buy stock these days. It was much more difficult in the 80s. But now, I mean, you go on Robinhood or FlatEx, or you have your app, and you can start investing right away. The entry barrier is very low. But just buying stock doesn't mean investing. When I researched Warren Buffett's story, there is one particular difference. He always said that every single day he reads 500 pages of quarterly and annual reports, which principally is the most boring thing you can do throughout the day, going through 500 pages of quarterly reports to come to informed investment decisions. And I think this is a huge difference between the retail investment world and the professional investment world, and which makes me curious in your direction. How many pages do you read these days? Can you say that? I mean, the internet is, I think, also a valuable source of information. How much time do you spend researching?
So I have one real thing which I like is to read investment books. This is what I love, and I think it would be arrogant not to do it, because every investor, also like Ray Dalio, but also everyone else, at some point when they grow a silverback, then they start spreading whatever they have learned out throughout their lives. So within 5 hours, you can learn from the best people in the world what they have learned. So definitely you have to do that. I'm very against reading too much newspaper, because I think this noise, I think this takes out a lot of the smart reasonings which you can have. And they're kind of toxic in the way, because they influence your emotions about something. And if those journalists would be so good in evaluating those stocks, markets, so on, they would be investors and not poorly paid journalists. But what I also like to read, and what I can also encourage everyone, is to read the memos of smart investors. So, for example, the quarterly letters of hedge funds, of Oaktree, as I mentioned. I think there's a lot of valuable insight in some of those bright minds, to learn from them and to understand what their thoughts are behind something.
I couldn't agree more. Navigating the internet is a little bit tricky. I mean, you have to turn down the noise, so find some ways to navigate through the noise on the market, like newspapers. But the access, I mean, the Berkshire annual shareholder letter is just available at the fingertip. Ray Dalio has a LinkedIn profile where he puts out know-how on a daily basis. So you can just subscribe to his newsletter, subscribe to his LinkedIn profile, and get his investment wisdom on top of his books delivered on the computer screen. In the 80s, it was completely different. There was nothing available. And getting the wisdom of an investor like Warren Buffett meant working hard to be on his team, which is was next to impossible from Austria. And now he shares openly his wisdom. It's really a great thing. When we come back to your company and the fundraising story, there are always these hero stories on the market. I had a phone call this morning where we're talking about the duration of fundraising, and my experience always was the same. It's pretty tough. It takes long. It needs a a lot of phone calls. And a couple of years ago, I heard from tech companies, 6 weeks, and they got 2 million on their bank account quite easily. So I questioned myself and said, have I really the right approach? Why do I need so many phone calls? Maybe I'm in the wrong industry. I'm curious to learn in your industry, what's the reality of fundraising? So when we talk about preparation and duration of the fundraising cycle, is it a question of weeks, or is it more on the side of being on the market for a couple of years?
So it was definitely not a question of weeks. It takes a long time, and it's also very important to set the ground rules in your shareholder agreement and your articles the right way, so that everybody is doing the right thing for the right reasons. And we by now have 8 external investors, which makes it obviously complicated. And yes, you're right, a lot of phone calls, a lot of different opinions, a lot of different thoughts, a lot of different arguments. What we always had, we had our first investor, external investor, and my co-founder and me, we were like holding almost 100% of the company. And in the next round, what we did is Dirk and the first investor, they both invested again, which made it much, much easier because we could set the rules ourselves, the price and so on. So the more investors you have already lined up, the more the rules are set, the more the price is set, the more they are not going to question anything. And you have to be very honest, it's also some kind of herding. So the more investors already agreed to do it, the more people are also aware that other people already have looked at it, and the scrutiny decreases by the time you onboard investors.
So one of my key figures always was when I talk with startups, when you want at the end of the funnel, at the end of the day, one investor coming out of your funnel, you need to input at the top of the funnel 100 investors. So you need to reach out to 100 investors to get one investment down. It's a success rate of 1%. What is your success rate when you think about the financing industry? How many phone calls do you need, in your opinion, to reach out to investors so that you get one investor on board of your company? Is it 10? Is it 20? Is it 30?
Yeah, I would say it's 10 to 20, but I don't know. We have been talking to so many people throughout the last few years, so I don't know. Mostly the best investors turned out not that we approached them as investors, but as we just wanted their advice for things. So usually, if you want money, you should ask for advice. If you want advice, you should ask for money. This is a saying, and I think it's very, very true.
Yeah, that's a good proverb. How did you prepare for the fundraising? Did you have an internal strategy session? Did you prepare the company in a special way, or is it just going out of the market talking to people?
Yes, just talking to people. So we already obviously had a plan for our next 5 years, what we wanted to do, and we didn't, and hopefully we don't have to in the future, like rush anything or kind of do things just to get investors. So we told them what we're doing or what we're planning to do, and try to find people who want to take this journey with us and not the other way around. I know that some companies are also trying to like put everything in place that investors will like that. We did it the other way. Lucky enough, it did work out well, and we have really cool investors, really cool add-ons, sparring partners. But let's see what the future brings. I think this is, as everything else, this is also in emotional cycles, as you have seen for funding rounds, which have been happening in the last 2 years. And this year, it's very different. It's a very different environment, very different money availability. So I think a lot of luck has to play into your cards, also to find the right people at the right time, for the right reasons. I think you can hardly plan that to be perfect. You just have to be lucky and also be well prepared that if there's an opportunity arising, that you can kind of grab the luck and not let it go.
Now, there's a lot of value in what you're saying in the last couple of minutes. I think one of the points that many founders sometimes forget is this I just call it alignment of beliefs and values. You said that you were lucky to find investors that are aligned with your company's vision and mission. Did I get the right picture?
Yes.
How did you do that? Do you have a secret, or did you discover a secret how to get the right investor support? Which questions do you ask?
No, I think we didn't get a secret. I firmly believe that we are doing the thing we're doing for the right reasons. I think people also feel that, and we talk to a lot of people, and we also get better with every conversation we have. We try to learn from people. We try to kind of stick to a long-term path, but nonetheless get as much input as we can. Often this is obviously diluting our time a little bit, but in the end it's worth it, because everybody always thinks you start something because you have the perfect idea. But in the end, when you start, there's almost nothing, and there's so much to be shaped, so much to be changed, so much to be done differently. And you need such a conviction in it, because everybody will look at whatever you have and say, yeah, but this is not special. But obviously it's not special. It takes a long time until something becomes mature, until something works out perfectly, until everything is fine, until you can articulate the vision, until you can like deliver what you promised to deliver. This is like always an MVP, whatever you're doing. So therefore you need a lot of input, and you need to be as I said, like ask the right questions. And if people understand that you could be like nobody knows, you could be the right person to do this, then I think they're much happier to entrust you with money than if you're doing it for other reasons.
I completely agree with what you say. I think at the end of the day, when we look at companies, almost nobody is doing something special. When we're talking about Jeff Bezos in 1995, 1996, 1997, I think he was called the nerd of the Amazon. And the only thing he did with his team was selling books online. And a lot of companies appeared on the market who tried to mimic and copy his model. I mean, for me as an avid reader, it was mesmerizing to get access to the world's library. But for the majority of people who owned bookshops, there was just one question: why should anybody go online to buy books? And when they can just go around the corner to the next bookshop and can get it immediately, so why should you wait 2 weeks? I think the only thing that Jeff Bezos did was keeping going. I mean, he kept the momentum up and high and didn't give up and didn't stop. How do you see the importance of the execution on an idea rather than just having the idea?
Yeah, obviously that's at least as important, and that's also what you see with the successful startups. I guess those are not always the best ones, but the ones executed the best way, and obviously with some tailwind from market environment. This is also very important, but you also need to be ready to execute really well as soon as the market allows for rapid growth. I think this is one of the most important, but you're completely right with Jeff Bezos and everyone else. Like, they started with a tiny bit, made it right, and then grew and compounded what they know, what kind of human capital they can get, and what they can build out of what they already have achieved.
I mean, the tech bubble burst in 2000 was cruel. We are still nowhere near of this drawdown in 2000, 2001 in the tech sector. I think the biggest drawdown with Amazon, if I remember it right, was 90%. And the interesting thing for me is to understand why he didn't give up. So why he kept executing. I mean, there must be a tremendous pressure on entrepreneurs like him when the stock price just collapses, and a lot of people, I'm pretty sure a lot of people went in at the top and
Yes.
wanted the money out at the bottom. When I think now about your company, I mean, we had a little bit of a crash in 2022. Um, why should people now start investing with your? I mean, is it even possible that people can people already invest with your company? So can people already buy
Yes.
your products?
Yes. We do have a lot of clients already. We
Mm,
already have a reasonable amount of millions invested, and we did already invest for the last 3 years on
super.
behalf of ourselves and our clients. And I think the main reasons why people should invest nowadays is exactly what I said at the very beginning. I think the uh, bad market environment doesn't mean that there is no opportunities found. In opposite, like as soon as emotions are in play, people are making mistakes. The herd is looking into the wrong directions. And a bad macro outlook, if it's already priced in, can also mean attractive returns in the future. You always have to see people are very unhappy with uncertainty. It's very hard for us to handle uncertainty. But as soon as the uncertainty is gone, the opportunity of the price increases are already done. So what the smart one does at the beginning, and usually, unfortunately, the retail investor does at the end. So as soon as there's no uncertainty anymore, the big returns will be made already. And it's uncomfortable uncertainty. And this is also why you need an investment approach, as we have at Fruits, which kind of holds the mirror up and say, like, David, if you were rational, this is what you would do now. I think nobody gets the right moment. Nobody gets the best moment to invest. But the best moment probably is always yesterday.
That's true. That's true. I mean, what is the proverb? I think Rothschild said that buy when the cannons roar and sell when the trumpet's playing, or something like that. So
Yes,
just getting that right.
yes, but it's easier said than done. And I can tell you from my experience, whenever you have investors, clients, and so on, it is very tough to stick to your approach and process in times where everything is playing against you. And it doesn't matter what your approach is; those times will always come. And therefore, you need high conviction. And in order to have the high conviction, you need to do an incredible amount of research to be so convinced that you have an added value, because otherwise you will never manage to stick to your approach in times where the market is against you.
Absolutely right. I mean, this is something that I think is very impressive with Kathy Wood, because she sticks to her investment approach. It was much easier, I think, in 2020, 2021 to move forward. Also, when I look at Warren Buffett, he never gave up his principles, even when there was a lot of pressure on the media against him, because he's not investing in tech opportunities. He just was true to his approach. And it looks to me that it's just quite similar with your company, so that you have found your investment approach that works for you and works for your client, and you execute on that. What's the future of your company? I mean, you closed the financing round. You got, I called it the Austrians' most prominent bankers on your advisory board. So when we look at the website, I think everybody knows the people there. What's the future of your company? Is there a second financing round planned? Is there an opportunity for investors to invest in your company if they're interested in the financing market?
So in the end, the end game for us is very far away, but what we want to become is really a financial health company. To have the most important part about the financial health, the long-term investing as a core, and build around it useful things to help people to manage their finances in a smart way. In order to achieve that, obviously we have to grow big in order to offer this at cheap prices. It's a scale game. We have to grow big. In order to help as many people as possible, we have to grow big. We now have a good filled bank account since we have done a big financing round. So we really can focus on work now. Obviously, we're continuously talking with investors. I think what's important for us, and I already mentioned it a few times, if we find people who want to do this journey with us and who are a good fit, we will always take them on board, no matter at what point in time. But we're now not forced to take investors on board, but we would love to talk to everyone who could become part of the story and who could help us, because we will need a lot of money in the future in order to make this big as sustainable as possible. And what we also see is that the more solid our setup as a company is, which it is now, as we have a good financing, is the better talents we can attract. And I think this is a very important one, to get this visibility for people, like where it could end up with, and the strength to also be able to hire good people. And this really makes a difference. So therefore, almost all our money goes into human capital, and obviously later on it will go a little bit or also partially into marketing. But this is why we will always probably take the right people along, even if we don't have to, but we're very open to discussions.
So it's basically ongoing financings. Having the same values and the same direction is much more important than just getting a few bucks on a bank account. You mentioned your end game. I'm curious, what's your end game? Is it becoming the only single one solution on the planet for personal financing, for private banking, listed on the Nasdaq with a market capitalization bigger than Apple? How do you define your end game?
No, not at all. I think if we can at some point help a few 100,000 people to gain financial health and to make more out of their money and get them ready for their future in this complex world, I think we have achieved everything. And the result, if we achieve that, it will obviously be that we earn good money, but this is definitely not our main driver.
Oh, this is a great point. I think financial literacy and financial health are very important pillars of life. And I think it's really, as you said, it's absolutely necessary that people start immediately with small amounts to taking care of the future themselves, and not believe anybody who comes around and says, I will solve your problems in the future. So it's really something that people need to do for themselves. It's really good talking to you, but I have a few final questions, and
bring it on.
Let's make it free. Let's make it free. In the last years, ESG has become, I think, very important. So let's assume I'm an investor who really wants to make sure that all investments are according with ESG guidelines. I'm interested to hear from you. What's your take on ESG? What's your definition for that? And how do you implement it in your investment strategy?
Yeah, I think it's a very important topic, and it is, for our generation, it is already very different than from my parents' generation. I think it's also looking at investments. So for our clients, we ask them for how important sustainability is for them. And we are firmly convinced that it is the right thing to do to invest sustainable, even though it's not at a stage yet where it's really as it's supposed to be. And I also firmly believe, so first, it's the right thing to do. Second, it is kind of a risk management in many layers, in the layers of governance that a company set up the right way, in the way of taxes, which could come for any emissions which you can have. And in many, many senses, also headline risk, being in a newspaper as an unsustainable company. So I think to look at sustainability within companies makes sense on a risk management perspective and is the right thing to do. What I am very well aware of is that, as it is flavor of the month, is everybody's looking in the same direction. It can be also a danger of a bubble building. So that everybody looks into the same direction, does the same thing. It can also be dangerous. So what we're doing is we are building almost all our portfolios to a high percentage in sustainable products, meaning paragraph 8 and 9. So those are like the new regulatory requirements of the EU. And but what we're also looking at is we look at the indices on a sustainable level versus the indices on a non-sustainable level. And we'll have a look and we always observe whether they become much more expensive than the normal ones. Because I think our fiduciary duty is to make most out of the money of our clients. Second one is to have an impact. And this is exactly how we see it. If we don't have a trade-off on a valuation basis, we will always go for sustainability. If the difference between a sustainable index and the normal index becomes too high, we would switch to the normal one and do that. As I said, that's how we do it. And as I said, the sustainable products are not where they are supposed to be. I think everybody has to be very well aware by buying a sustainable ETF or fund. This is not impact investing. This is weighting it a little bit to the right direction. But the ripple effects are not that bad, or could even be great, because every company and every board will have their annual report, and wherever they will be judged on sustainable criteria. So every decision in the future is going to be taken, taking this into consideration. So every company gets better and better on those measures. So the ripple effects can in the end be quite good, even though the investment itself is not impact investing yet.
Yeah, ESG is a tough topic. I mean, environment, sustainability, and governance. So, I think it's a trilemma that's really difficult to integrate in one fund. How do you see it?
Yeah, definitely. So I think it's by putting too many different things in one bag, it becomes a not high conviction trade again.
Yeah, absolutely. When we talk about trends, I mean, I read Biden plans to pour hundreds of billions into ESG, whatever that means in future. So whatever companies he supports and areas he supports with that, it's something that is up to discussion. I think European Union is pretty much the same. We had a trend. I think ESG is now the big trend. We had a big trend with crypto investing, crypto funding in 2017, and then in 2018 everybody hated it. We had an uptake until 2021, and I think now in 2022 people are not so happy with that. We had trends in the chip industry. I think Nvidia, AMD were very big until 2018, collapsed with the crypto bubble, came back and now collapsed again. We had a trend in the last year with the pharma industry. My question to you is, how do you handle trends? How do you find the balance with your team between not missing out on trends, because it means just additional gains, but not being let's just thrown around by the winds of trends in your investment style? How do you find the right balance between traditional investing and also integrating trends to make more returns for your clients?
Yeah, unfortunately, I have to say, we will miss a lot of trends with how we approach the market. But as you saw with Arc Innovation, with crypto, whatever, trends come and go. I think this is not how we're set up, and this is not what we have expertise in finding the next big thing, which will work out for a while. We're really building portfolios for the long run, and therefore we will not be the ones making 700% a year because we found the best trend. Unfortunately, this is not something we can offer. We don't have expertise in this at Fruits, but what we have expertise in is doing the very boring thing, to invest money smartly for the long run. So
when we look at Warren Buffett and Ray Dalio, it pays off. So it pays off at the end of the day. Before I ask my final question, one question to you. Is there any topic open that you would love talking about on the podcast and that I didn't ask questions about in this recording?
Yeah, I mean, I don't know your last question yet. So
my last question, I can tell you, how can people reach out to you? How can people reach out to your sales team if they want to learn more about how to invest with Fruits?
Yeah, this is probably the most important question. So as I said, we want to be human where human is an added value, and not be human where it's holding us back. So on our homepage, everybody can, an offline or online meeting, can arrange it. So it's just one click, and it's like, I want to have an investment meeting with the investment team. And with this click, it already proposes you all the time slots which are available. And then we would love to discuss with everyone how to take care of their financial future, or just do a financial health check, or whatever they want. We'd love to get to know as many people as possible.
That's great. That's great to hear. Is there any topic open that you would like to talk at the end of the recording?
No, I think the only thing I can encourage people to do is not let the emotions guide them too much about what's happening in the world. A lot of it is priced in. A lot of opportunities arise from difficult times, and if you want to invest for the long run, really also use uncertainty to position yourself in a smart way.
David, thank you very much for this fantastic insight into the world of private banking, now in a new model. I wish you and your team all the best for your future. I'm pretty sure you will play a key role in private banking in Europe. And let's catch up in a year or so and see where the market stands then.
Yeah, time to deliver. Yeah, very cool. Thank you so much for your time. Really inspiring questions, and great to get to know you.
You're welcome, and I wish you and your team a great afternoon and a great week ahead.
Thank you.
Bye.
Bye.